Intel Corp is currently trading at $43.99 USD on the NASDAQ, showing a positive intraday movement of plus 1.50 points, which is a gain of 3.53% as of this Tuesday, January 27, 2026. This bounce back comes at a moment when most casual observers are looking at the recent earnings report and seeing nothing but red tape and missed guidance. But the tape is telling a much more nuanced story for those willing to look past the surface-level headlines. While the headlines focus on a first-quarter revenue outlook that fell short of analyst consensus, the real story is found in the manufacturing yields for the 18A node, which have reportedly climbed into the 70% range ahead of schedule. This is the classic tension between expectation and reality that defines the semiconductor space right now. The market expects a quick turnaround in profits, but the reality is that Intel is effectively building a massive industrial machine that requires years of upfront costs before the high-margin returns begin to flow. If you look at the heavy trading volume today, it is clear that institutional players are beginning to snack on the volatility, treating the recent price dip as an entry point while retail sentiment remains cautious. Most people look at Intel and see a legacy giant struggling to keep pace with the nimble nature of its competitors, but this view ignores the fact that Intel is the only company in the West successfully attempting to scale a leading-edge foundry on domestic soil. The narrative you see on various investing sites often paints a picture of a company in decline, but the data suggests we are seeing a massive structural transition. For instance, while NVIDIA stock continues to dominate the AI accelerator conversation, Intel has quietly shipped its first high-volume 18A chips, Panther Lake, which are reaching the market this week. The expectation was that Intel would struggle with power efficiency, yet early tests show these processors are competing directly with the best from overseas in terms of battery life and performance. This creates a curiosity loop for the patient investor. If Intel can prove it can manufacture these chips at scale with competitive yields, the entire valuation of the company has to be reevaluated, shifting from a struggling chip designer to a dominant global foundry. The recent stock movement has been a roller coaster. Just a week ago, the price was pushing $55 before the quarterly report sent it sliding back into the low 40s. That 20% correction in such a short window often triggers a panic among those using a Robinhood app or those who manage their own self-investing through an individual brokerage. However, the bounce we are seeing today at $43.99 USD suggests that the sell-off may have been overdone. Institutional activity shows that large funds are looking at the long-term roadmap rather than just the next 3 months of guidance. When you see a stock drop on weak guidance but find that the underlying product roadmap is hitting every milestone, you have to ask if the market is mispricing the risk. Many people using Interactive Brokers trading tools are seeing a spike in call option activity for the mid-year contracts, suggesting a belief that the bottom is in. The broader semiconductor sector is under immense pressure from macroeconomic shifts and trade tensions, yet Intel sits in a unique position due to its status as a domestic champion. The expectation is that government support through the CHIPS Act will be a simple cash infusion, but the reality is that these subsidies come with rigorous performance requirements. Intel has met those requirements, and that is why we are seeing continued support from major tech firms. There is growing evidence that Apple is exploring the 18AP process for its lower-end silicon, a development that would have seemed impossible just 2 years ago. This is the kind of information that rarely makes it to the front page of basic investing sites, but it is vital for anyone trying to understand the long-term trajectory of the business. Intel's business model is currently split between two very different worlds. On one side, you have the client computing group, which still generates the lion's share of revenue. This is the world of laptops and desktops, where Intel still maintains a massive installed base. The expectation here is that AMD and ARM-based chips will slowly eat Intel's lunch, but the new Core Ultra Series 3 is showing a level of integration and AI performance that keeps Intel firmly in the lead for the average consumer. On the other side, you have Intel Foundry. This is the great experiment of CEO Lip-Bu Tan. It is a capital-intensive bet that involves opening up Intel's fabs to outside customers. This is why you see such high volatility in the financial reports. Building a fab costs tens of billions of dollars before a single chip is sold. For someone looking at their Fidelity mobile app and seeing a quarterly loss, it can be scary. But for someone looking at the long-term growth of the silicon market, it looks like a necessary cost of entry to remain relevant. The data center segment has been the biggest pain point for Intel recently. While the market was expecting a faster recovery, the reality is that NVIDIA stock has captured the massive spend on AI training. Intel's Gaudi 3 accelerator is a solid product, but it hasn't become the default choice for the hyperscalers yet. However, the upcoming Xeon 6 series, specifically the Clearwater Forest chips built on 18A, represents the first real chance Intel has to take back meaningful market share in the server space. These chips are focused on efficiency and density, which is exactly what cloud providers are asking for right now as they struggle with power constraints in their data centers. This is where the tension between expectation and reality will be settled. If Clearwater Forest can deliver the promised 17% IPC uplift, the entire bear case for Intel's data center business starts to fall apart. For those of you managing your own portfolios, whether through Fidelity Investments or an Interactive Brokers account, it is important to keep an eye on the institutional ownership levels. Currently, institutional interest remains high, which provides a floor for the stock. Even as the price fluctuates, the big players are not abandoning ship. They understand that the semiconductor cycle is long. If you are using tools like Schwab Intelligent Portfolios or a SoFi Robo-Advisor, you might notice that Intel often remains a staple in diversified tech holdings, despite its recent underperformance relative to the S&P 500. The valuation, currently trading at a price-to-sales ratio much lower than its peers, offers a margin of safety that you just don't find with the more hyped AI names. I want to hear from you on this because the sentiment around this company is so divided. Comment below how many shares of Intel stock you currently hold, or if you are waiting for it to drop below $40 before you consider adding it to your portfolio. It's interesting to see how the retail community is reacting to these swings compared to the long-term institutional holders. The older reports from 2024 and 2025 showed a company that was bleeding cash and struggling with its manufacturing process, but the transition to the 18A node has been a significant turning point. The previous failures in the 7nm and 10nm cycles were due to overcomplicating the lithography process, but under the current leadership, Intel has returned to a more disciplined engineering culture. Now they are using high-NA EUV machines, being among the first in the world to deploy this technology at scale. This is the technical reality that the market often ignores in favor of short-term earnings per share figures. When a company is the first to use a new manufacturing tool, there are learning curves and costs associated with it, but once they master it, they have a massive competitive advantage. Looking at the future outlook, there are several catalysts on the horizon. The second half of 2026 will be the show me period for Intel Foundry. This is when we expect to see firm commitments from major fabless companies. If we see a deal announced with a firm like MediaTek, or even a partnership with a major cloud provider for custom AI silicon, the stock could see a massive re-rating. The risk, of course, is that these customers stay with the established leaders in Taiwan. This is the gamble of self-investing in a turnaround story. You are betting that the reality of Intel's technological progress will eventually overcome the market expectation of failure.
If you are looking for investment help or exploring different investing sites to find the next big winner, it is easy to get distracted by the high flyers, but sometimes the best opportunities are found in the companies that everyone has given up on, provided the underlying engineering is sound. Intel is currently a massive engineering project disguised as a public company. The stock price of $43.99 USD today reflects a market that is still skeptical, but the intraday gain of 3.53% shows that the skepticism is starting to crack. The supply shortages mentioned in the recent earnings call are a short-term headwind, but they also prove that there is high demand for Intel's products. They wouldn't have supply shortages if nobody wanted their chips. When you look at your Fidelity trading platform or check your Robinhood stock trading activity, it's easy to focus on the daily green and red bars, but the real gains in the semiconductor industry are made by those who understand the manufacturing cycles. Intel is currently at the bottom of a very expensive cycle, moving into a period where their investments should start to pay off. The 14A node is already on the roadmap for 2027, and the company is already securing the necessary equipment. This shows a level of confidence in their own roadmap that hasn't been seen in over a decade. They are